Exchange Rate Policy and Full Employment by Warren Mosler. Currency Boards. A currency board, as in Hong Kong, is a fixed exchange rate policy that differs from the Russian case in that all bank deposits are not convertible at the monetary authority. In fact, only those actual Hong Kong dollars issued by the monetary authority are convertible. These can be held as cash or as Hong Kong dollar balances at the monetary authority's designated bank. If a holder of bank deposits wishes to convert his Hong Kong dollars to US dollars at the monetary authority, he must first withdraw the funds. As banks do not have sufficient reserves of real Hong Kong dollars for all depositors, banks can be forced to suspend withdrawals if depositors try to demand more Hong Kong dollars than the bank has on hand. To get additional Hong Kong dollars for depositors, the banking system must somehow obtain US dollars and exchange them for the needed Hong Kong dollars with the monetary authority. The Hong Kong dollar interest rate settles at the indifference level of borrowing Hong Kong dollars versus US dollars. Again, listing the same choices of the marginal Hong Kong dollar. 1. Hold the Hong Kong dollar as cash or as a clearing balance. 2. Convert to something else at the monetary authority. A. Purchase Hong Kong dollar government securities, or B. Convert back to US dollars at the monetary authority. However, in this case, 2A does not extinguish the clearing balance from the private sector, as the Hong Kong government does not have an account with the monetary authority, but must use a private sector account. So 1 competes with only 2B. The question of why anyone would want to obtain Hong Kong dollars can be answered by citing the convertibility to US dollars. The question that then follows is, why would someone want to hold Hong Kong dollars? The answer is the higher interest rate that can be earned on Hong Kong dollars versus US dollars. That leads to the third question, which is why anyone would want to borrow Hong Kong dollars at a rate higher than he could borrow US dollars. One reason is the risk of devaluation. With devaluation, the borrower gains and the saver loses. From this, we could deduce that the reason savings are kept in Hong Kong dollars is because the interest rate is higher than that of the interest rate paid for US dollar deposits. And in fact, it is observed that the Hong Kong dollar interest is always higher than the US dollar interest rate. Otherwise, in theory, no one would hold Hong Kong dollar deposits. Well, that explains why someone would hold Hong Kong dollar bank deposits, but actual Hong Kong dollar obtained from the monetary authority do not earn interest. So why would anyone want to hold them, apart from cash in circulation? The answer is bank reserve requirements. In order to borrow Hong Kong dollars from the banking system, where loans create deposits, the banks must carry sufficient Hong Kong dollars reserves to support the higher deposits thus created. And to get those Hong Kong dollar reserves, the banks must borrow US dollars and exchange them for Hong Kong dollars at the monetary authority. That is, the banks must go short US dollars and long Hong Kong dollars to support their Hong Kong dollar lending activity. The Hong Kong dollar interest rate the banks charge reflects this risk. It is the same type of risk that any depositor of Hong Kong dollars face. The banks need to keep actual Hong Kong dollars to meet depositors' needs for the withdrawal of actual cash. Cash withdrawals actually convert bank deposit money into real Hong Kong dollars for the bank's customer. But the end of this logical chain has not quite been reached. We have explained why someone would hold both actual Hong Kong dollar cash and required bank reserves, why someone would hold Hong Kong dollar bank deposits higher interest rates than US dollar deposits, and why someone would borrow Hong Kong dollars as a bet on devaluation, but so far, this is a non-starter. The final question is why sellers of real goods and services want Hong Kong dollars, as evidenced by the fact they price their goods and services offered for sale in Hong Kong dollars. The answer, of course, is government. Tax liabilities are denominated in Hong Kong dollars, and government expenditures, including the payroll, are paid in Hong Kong dollars. If you are a business or individual that must pay taxes in Hong Kong dollars, you must sooner or later offer something for sale in exchange for the needed Hong Kong dollars. And as tax liabilities are ongoing, there will likely be a desire to net save the unit of account, if for nothing more than transaction purposes.